Today, I'm going to let you in on a little secret. Have you wondered why the world's largest asset managers, institutions, governments, everybody has flipped from bearish to bullish Bitcoin? It's not that they haven't known about this before. It's that they literally have nowhere else to go. In today's video, guys, I'm going to uncover all the details of what's going on in the traditional market, why it's not looking so good. And in this video is going to be one of the most important things that you can understand about the macro markets at large and why everybody is all of a sudden FOMOing into Bitcoin and the cryptocurrency market. All right, guys, if that sounds good to you, make sure that you like the video. If you're new to the channel, what's up? My name is Kyle Chasse. I've been in crypto for 12 years, bringing you guys everything that you need to know to understand the macro market, the Bitcoin and crypto market, and how to make sure that you are well positioned for the upcoming super cycle of a lifetime. And yes, ladies and gentlemen, you understand today why I'm saying that we have a super cycle. This will all make sense to you. I'm uncoding and unrevealing all the hidden secrets. Not so hidden, but if you know where to look, you can find them. So today was incredibly helpful for me to understand all this stuff. I'm going to bring that to you guys right now as well. So let's go into what's going on in the macro market. And also stay tuned to the very end because I'm going to show you guys some Bitcoin trades that I'm in, a special group that I have for people who want to learn how to trade and make money longing Bitcoin, because I don't short Bitcoin, in this bull market, as well as a certain altcoin that's come onto my attention and the radar soon, which I think has really, really bullish potential. All right, guys, let's get into it. So first and foremost, let's go talk about the traditional markets, right? Michael Burry, this guy is well known for his movie The Big Short and calling the 2008 financial crisis, and he is doing really well in his positions right now as the S&P and NASDAQ have stumbled 8 and 9% respectively. Now, let's go into what's going on here. So we have some analysts talking about the fact that we could see a major market correction in the stock market. Now, we know from the video that I made recently that we've seen a uncorrelation of crypto or Bitcoin and stocks. And will that trend continue? I'm about to go into why the stock market is falling and why Bitcoin is seeing strength. This will all make perfect sense to you guys as we go through this. So the first thing that we need to understand, what's really, really important here, is what is a bond, right? Let's learn about this for a second.
U.S. government bond yields are a barometer for the economy, but they're also more than that.
U.S. government bond yields are extremely important to the U.S. and even the global economy. Bond yields affect everything from the cost of a mortgage to the cost of borrowing for businesses. If you're borrowing money, that's going to be determined to a large extent by U.S. government bond yields.
And changes in yields can impact you. Here's how bond yields work and why they're so crucial to the economy. When we talk about a bond yield, we're typically talking about the annualized return an investor earns by holding a bond until its maturity date. Let's break this down. A bond is a contract with features that are set from the start. There's the maturity date, which refers to the length of the bond's life. This is generally 2 to 30 years. Bonds that mature between 2 and 10 years are also called notes. Then there's its face value, which is the amount the bond is worth when it's first created, and the amount it is guaranteed to pay on the maturity date. There's also the annual interest rate, otherwise known as the coupon rate. This is the fixed amount a bond pays each year up to its maturity date. So say an investor buys a new 10-year treasury note with a face value of $1,000 and a coupon or yield of 4%. Every year, the investor will receive $40, and on the 10th year, she'll get back the original $1,000 she paid for the bond. But here's the thing. As soon as she buys that bond, she can sell it to other investors. And when she does, certain features of the bond are subject to change. If the economy is doing well, interest rates may go up, which means new bonds will be issued at a higher yield, bringing down the value of existing bonds. Say a new batch of 10-year treasuries pay a yield of 5%. Suddenly, this bond is less attractive to investors, and the price has dropped. When the price goes down, the yield goes up. And when interest rates go down, this same dynamic happens in reverse. The inverse relationship between the price of a bond and its yield is key to understanding why investors care so much about bond yields, and why you sometimes see yields and stocks both going up at the same time.
Investors.
So we have a different situation right now. We see an inverse relationship, and typically this is what happens. When bond yields increase, stocks go down because they have to understand and weigh out the risk to reward ratio. So right now, if you can get issued a new bond at 5%, all of a sudden, and they have historically been incredibly risk adverse, or have been known as one of the most safe U.S. Treasury bonds or Treasury bills, have been known as one of the safest investments because the U.S. has always paid them back. But in this video, we're going to go and talking about why that isn't maybe looking so appealing to new investors right now. So you can see a record-breaking crash in bonds is a threat to stock prices and American jobs. Here's everything you need to know about the Treasury market turmoil. So Treasury prices have plummeted, setting benchmark 10-year yields above 5% for the first time in 16 years. And as we come down here, we can see, why does any of this matter? First, the rapid rise in bond yields is bad news for stocks. Equities started this year on an AI-powered tear, but the rally has fizzled out in recent months, and juicier debt market yields, coupled with worries about higher for longer interest rates, have been one factor that has fueled the slowdown. That's because when yields are higher, the more incentive for investors to pivot to bonds, lower risk assets that offer higher relative rate of return. So what it's saying, guys, is that essentially right now, because the bond yields have increased so much recently, that investors are looking and weighing their odds and saying, where am I in the stock market? The stock market has already been on a bull run this entire year. But now that they can get a much safer alternative investment in bonds, it causes them to redo the analysis and redo the valuation on stocks and say, is this still a reasonable price I'm paying for stocks? And do they have much more upside to go, or are they overpriced and overvalued? And if that risk to reward becomes too high, then bonds look like a good place to put money. And so they'll sell off equities, stocks, and start buying bonds. However, in this situation, we see massive, ultra black swan event, essentially, not black swan because it didn't happen all at once, but it happened very, very quickly, that we saw a collapse in the bond market. Since March 2020, Treasury bonds with maturity dates of 10 years or more have plummeted 46%, Bloomberg says. That's just under losses seen in the stock markets when the dot-com bubble burst. The bond rout was worse than the one seen in 1981 when 10-year yields neared 16%, guys. The bond market sell-off sending yields soaring is starting to eclipse some of the most extreme market meltdowns of the past era. Bloomberg reported losses on Treasury bonds with maturities of 10 years or more had notched 46% since March 2020, while 30-year bond had plummeted over 53%. So guys, if you had a 10 or 30-year bond, on average, you lost 50% of your value. So if you bought a bond for $10,000, it's worth $5,000 today. Horrible losses in bonds, making people question the value of these bonds as a secure, safe asset. Also, what we know that inflation, because of CPI increases, and I'll get into that in a bit, but CPI, inflation is still on the rise. In fact, it's been up this year, and we have not gotten that under control despite the rising interest rates. So interest rates remain high, inflation remains high, and this is bad for the markets altogether. So let's go back to this area here. So we're in a world of risk where for almost 15 years the bond market was in a bull market. You've had rates negative for several years. That dynamic fed throughout the global economy where housing prices were affordable, autos were affordable, and people were subjected to an environment and a lifestyle which had much lower interest rates. So now is where we get into the part of the video where we talk about what Larry Fink has said. And if you guys haven't seen this before, let's just play it real quick. Most of you guys have seen this.
This rally is way beyond the rumor. I think the rally today is about a flight to quality with all the all the issues around the Israeli war now, global terrorism. And I think there's more people running into a flight to quality, whether that is in treasuries, gold, or crypto, depending on how you think about it. And
so why has Larry, and I'll just play this in the background for you. I'm not going to play it with sound because I might get a copyright thing. But anyway, you can see this is in 2018, saying that how much money laundering is going on and criminal activity. So the question, and you can see here in the background, let's let it play. Why has Larry Fink and everybody else, they've known about Bitcoin. They know what it's about. It's not like they all of a sudden in 2023 learned about what Bitcoin was and all of a sudden decided that it was a good place to park their customers' money, right? And we're going to get into that in this part of this video of where else, if stock market is in danger, where else can people possibly deploy their capital in order to try to prevent things like rapid debasement of the dollar, right? Which is going to come from massive inflation. We've got war times. I mentioned on my video on Friday that there's the largest stimulus ever by the Biden administration, almost $1 trillion put into that has been outside of wartime and outside of pandemic. Largest stimulus ever. New money being put into the economy, which causes the devaluation and purchasing power of the dollar. So do you want to keep your money in dollars? Probably not. Interest rates, rapid rising interest rates it's bad for business, it's bad for banks because businesses because businesses cannot take out more loans to expand their businesses. If they do, it's incredibly high interest rates, which lowers their profitability, it lowers the cost of capital. Also, high interest rates are bad for the consumers because high interest rates are going to lead to higher credit card payments, higher auto payments, potentially higher mortgage payments, depending on if it's a fixed or if they have fixed or variable rate loan on their mortgage. And with the devaluation of the dollar that they're earning and the increased cost of living for them, increased CPI, groceries are more expensive. That means that consumers and retailers have less money to spend, which means that businesses will make less money, which means that their earnings will be less, which means that their stock prices will be worth less. Guys, this is very easy to see. So again, the question is that everyone's looking at is where is the flight to safety? Where is the flight to quality, right? Because housing markets aren't good. So real estate is out of the question. We know that commercial real estate, if you've been watching this channel, ever since the pandemic, most people aren't working from offices anymore. A lot of people are working from home. And so commercial real estate has zero demand, which is lowering prices. So commercial real estate is a very bad place to put your money. Residential real estate, read this title, home prices have soared so much that 98 out of 100 biggest US cities are overvalued relative to historic values. So the real estate market's at all-time highs. That's not going to go any higher, right? Especially when people stop being able to pay their mortgages and we have foreclosures. And I in one of my videos I made a few weeks ago, I talked about mortgage rate foreclosures and how that is skyrocketing as well. So when you have all of this inventory that comes out for sale and banks are selling foreclosed homes, or people need to sell their houses because they can't afford the payments anymore, or because their cost of living is increasing too much, then the housing market will come down to, that's not a good bet, not a good place to put money. What is this? So this is talking about the CPI. I just talked about this, right? So to show you guys, the so-called consumer price index, which excludes food and energy costs, has increased 0.3% in September. Bureau of Labor Statistics data showed Thursday. Economists favor the core gauge as a better indicator of the underlying inflation than overall CPI. That measured climbed 4%. And you can see here the change in services, excluding housing and energy, month over month is the fastest incline from June till now in October that it has been for years. Well, maybe this one in here is pretty high, but anyway, it's been incredibly high. And so you have everything I've just been talking about. So again, the question is, we know that bonds are not attractive anymore, right? Because you have also an all-time high debt. And I think I think it was in the clip that I showed you guys on Friday in the video where Larry Fink was on stage at the FII, the Financial Investment Initiative in Saudi Arabia, with all the other most powerful asset managers and investment managers and owners of banks, and Jamie Morgan and Ray Dalio were all on stage, essentially saying that you're going to have continued increase in the rate of interest rates for a long period to come because inflation isn't under control anymore. So we know there's going to be lots of inflation. We know that there's going to be lots of stimulus coming into the market because we have an election year coming up. We have the stock market going down. the stock market cannot be weak and going down in an election year. So of course they're going to have to print money. You're not going to want to buy stocks because that's unstable right now. Those have been going down. You don't want to catch a falling knife and try to buy the dip on stock market right now. And you don't want to buy long-term bonds or treasury bills because it is uncertain whether the US will remain solvent. Larry Fink on stage at the FII said that there's over $1 trillion a year. He said in 2002, I think he said, 2002? He said that the global debt, the US debt was $8 trillion. And now it's over $33 trillion. That's a rise in debt of over $1 trillion a year. So with the US debt just growing exponentially here, are you confident in a long-term treasury bill or bond where the US promises to pay you back when they can't even pay back their own debt, right? So the longer you take risk on these bonds, the higher your risk becomes. And with raising interest rates, the bonds you buy today might be incredibly devalued by next year if the rates continue to raise. Interest rates that we have right now at 4 or 5% are not even as high as they have been in some of the worst economic times. We've seen things go up to 10%, 12% interest rates. And so if you bought a bond today or over the next 6 months and you got a 5% on that bond for 10 years, and all of a sudden interest rates go next year up to 8, 10%, guess what? The bonds you bought today are going to be worth way less, probably 50% of what you bought. So bonds are out. So if you're not buying real estate, you're not buying stocks, you're not buying bonds, what else are you going to buy? Well, you're going to buy either gold or a better version of gold, which is Bitcoin, guys, right? So you can see that this is gold here, this candlesticks. This blue line is Bitcoin, and this orange line is the S&P 500, which we do have a little bit of a correction up today, right? Up today of like 0.7%, and also crypto going up as well. But could this just be another little, uptick in the overall? You see plenty of these little upticks in this overall downward trend in the stocks. And so it's very, very concerning here, guys. And you can see here that we have finally some inverse correlation between Bitcoin and the S&P 500, right? You can see here in the last measured thing, I think it was, October. Yeah, so here you go. You see October, today, basically, where you have the Dow Jones as a negative 0.8. -1 would be completely inverse, meaning that it's a complete, total inverse relationship where if stocks go down, Bitcoin goes up exactly, right? But you see 0.8, which is pretty dang negatively correlated. So that is just clear signs, you guys, of what's coming ahead. You can see here that there's nowhere else to go. And this is why the narrative has shifted from Bitcoin as, a money laundering, illegal, illicit activity kind of narrative, because there's nowhere else to go. So timing is everything, guys. And those of you who have had conviction for a long time in Bitcoin have always understood its underlying value, right? Unlike money, like fiat currency, unlike gold, we know that there's an artificial cap, right? We know exactly how scarce Bitcoin is. There will only be 21 million ever created. We know that between 4 and 6 million of those have been lost forever, which makes it even more scarce. No more will ever be created or minted. And that's an incredibly finite and rare thing, which makes it better than gold. It is unconfiscatable. It is divisible. It is transferable. You can travel across borders with as much Bitcoin as you want. You don't have to be worried about stopping if you have cash or gold. It's a better version of gold, right? And so this is really the only place to go. And so it makes perfect sense why these institutions want to start offering this precious asset to their clients, right? To make them money. So this is not just, Larry Fink coming up and just figuring it out one day, right? This is a flight to safety, as he calls it, out of necessity, out of total necessity, guys. So let me show you this trade that I'm in right now. Up 41%, guys, on this trade. I've had this open for quite some time now, quite a few days. And if you guys want to long Bitcoin, like I'm longing Bitcoin, make sure to use the link in the description below. You guys will get a nice, fat, juicy sign-up bonus using my Bybit link down in the description below. And I also have an alpha group. If you sign up to Bybit, start trading with me, and I will let you into this alpha group I have. Let me see if I can show you real quick. This is the VVIP group, and you can see in here we drop daily charts, lots of different charts in here on different altcoins, different TA. And what I drop, which is really, really interesting, guys, which I'll show you here, is these AI-generated technical analysis. Now, I know some of you guys might think that that is silly, right? But to show you what I'm talking about here, these are the, actually, let me just show you here on my dashboard here. So this is an example. This was generated 3 hours ago. I dropped it in the VVIP trading group. And you can see that it is, 78% of technical indicators are flashing bullish. Here's the targets that it's aiming for. 38,592 is the next target from the time this was generated. The time it was generated, the price was 34,571. And you can see as you go down, it has all kinds of things like RSI, moving indicators, support, resistance, and you can show you how many things are here on the, if they're buy or sell. And so it's been very, very spot on, guys. And you can see here in my dashboard, that out of all the times that I've generated one of these analysis, the levels have either been maintained, and the rare case where this is still an ongoing trade, or you can see that the target has been reached. Never has it been invalidated since I've been using it for the past 11 days. So all my trades have been positive. Not saying I'm a genius by any means, but this is a tool that we should be looking at, right? This is better. This essentially is like large language learning models are able to take the best of everything. We know that these AI are beating the best players in the world at chess, at Go, any type of game. And technical analysis and trading is a game, right? And who's the best going to be at it? It's going to be AI, right? So in my group, I also offer you guys this exclusive access here. I pay for this service, but I share it with you guys for free. And as well, guys, this is something that's been really, really interesting. I'm just going to share it with you here. I don't have super high conviction in it, but I did buy it and dropped it. Also shared that in the VVIP group at a $2 million market cap. It's up almost 100% or over 100% since we shared it. And you can see here that what 0x leverage is. It allows you to essentially bet small amounts, whatever you want, on all of these like meme coins or whatever you want, any new altcoin that pops up. And all over the timeline, if you search in X for 0xL, you can see people sharing their screenshots of the trades that they made, and they're making crazy gains. I saw one today where some guy, put in $5, it turned into $2,000, like that, right? And of course, you can lose it, but it's really a good opportunity because you cannot leverage trade any of these small meme coins or small caps on big traditional exchanges. So you need to find another way to do it. And to me, this is really innovative technology with a big use case and probably going to be generating big revenue. So at this tiny market cap, in my opinion, it's a great buy. I bought in on it. I'm probably still going to continue to do that. All right, guys. And that's going to be it today. I'm going to wrap it up. See ya.